pretty good, and we are virtually at all-time highs now. I mean, just about 20-30 points away from there. The first tick is in the green, well, within kissing distance of that all-time high. So we'll keep our eyes peeled on that. Well, the mid-cap index
Sonia,
is the
by the
one
way, we got to within 6 points of it at the day's high.
I think it's the mid-cap index where the party continues, right? We just keep quibbling about the nifty, but the mid-cap index is up almost about 0.5%. Very good opening, really, for the markets. Dr. Reddy's is your big mover, up about 1.5%. Ekta was telling us about the positive news for 2 of their facilities. So that's the big mover on the index. Apollo Hospitals not too far behind. Metals have come back in a big way in the last many days. So Tata Steel is up about 0.7%. JSW Steel is up 0.4%, and JSPL, you just heard about the Kotak upgrade over there. Nifty, by the way, now just 26 points away from that all-time high, resuming that all-time high rather. So we're going to keep our eyes peeled for that. The advance decline ratio is well in favor of the advances, almost 1,800 stocks there. On the downside, what's dragging is Hero MotoCorp. There is that downgrade that has come in, from Axis Securities. You just heard from them a while back. Apart from that, the weakness in the monsoons is something that will impact some of these rural stocks, so keep an eye out there. HUL is also dragging a bit. Reliance is in the back foot this morning. Bharti Airtel as well, not doing too much. IndusInd Bank, NTPC, a couple of other stocks that are in the red. But give and take everything, this is a good opening. This market is all set to hit those new highs. Whether we achieve them today, in the next 1 hour, 2 hours, it doesn't really matter because we're virtually at those levels now.
I think sometimes, when you stop looking at the board at that countdown timer, that's when things happen. So who knows? But anyway, look at the strength of the mid-cap market. We are up and away. JSPL, the stock that, Sonia was just talking about on the back of the upgrade, straight away 4.5% higher. Shriram Finance, a bunch of these NBFCs, you've heard a lot of upgrades on the NBFC pack today. Shriram Finance is up and about. I think there was supposed to be a block as well. Nimesh was alerting us about that. So we'll keep an eye out on it. 5-Star Finance, where upgrades have come in. Kalyan Jewellers, there were blocks on Friday where 6% equity moved around. And there's a further follow-on action on the stock today. It was up 10% on Friday, another 4.5% today. Mishra Dhatu, the defense theme is well and truly active, so 5% up on this one. Axis Gates News, they have, I think, completed a small acquisition, so 5% on that stock. So it's really, by the way, 18,872. We need to get the timer back on, right? That board. 873, 871. It's practically there. 14 points, 15 points. Mid-cap market is saying, hey, you know what? We are having a big party and a big breakout of our own, so not really waiting. On the mid-cap screen, more names like NMDC Steel, Mannapuram, up and about. So it's looking good. In terms of the watch list, stocks that are on the back of news flow, moving on the back of news flow, Mannapuram 2.5% higher, HAL is 2% higher. Some of these defense names like Paras Defense, MTAR, also fairly active as we start the day off. So 74, 73, 74, Prashant now. It's teasing, just a couple of points away.
Oh, yeah, it's, just a couple of points away.
76.
And it'll come. A matter of time. Now, just a couple of other names where we can see where we are seeing some action. HAL, for example, is there right at the top of the list, gaining list. We put out news flow there as well. So stocks up about 2.25%, but huge volumes in it. There is JSPL, which is up about 4%. Of course, the upgrade, as Sonia was highlighting. Kalyan Jewellers is another one. I think last week was a good one for Kalyan. And that is up 4%, 136. Shriram Finance, we highlighted that. Mannapuram is up about 2%, 128. Skipper is another one which is coming up with a 14% gain. And these are the kind of names which pop out of nowhere in the mid-cap, broader market space, but huge volumes on Skipper for this time of the day, as you can see. Now, there is 5-Star, which is the Chennai-based NBFC, relatively newer listing in the market, 5% higher on that one, 631. There is Borosil Renewables, which is coming up with a 7% gain. So some new names, 570. There is Texmaco Rail, which is up 3%, and so on and so forth. So this is, the broader market list, which is looking very, very solid right now. On the downside, DMart is down 1%. It's coming up with volumes, so just highlighting it. Tata Communications is down about 1.5%, 1604. And I think we've got Varun Beverages and PVR, which are down 1.6%. Signed is another one which is seeing some profit booking as well. So just kind of, middling kind of activity on the downside, but enough and more on the upside. So
yeah, I just want to mention that this market is so secular in nature, right? I mean, if you look at the list of gainers or the list of stocks at 52-week highs from the large caps, it's across the board. So something like a Titan is sitting at a fresh 52-week high, Dr. Reddy's is at a fresh 52-week high, ABB India, Cummins, PI Industries, Britannia, Chola Finance. So the list is pretty long and it's spread out. So this is a market that is starting to sort of spread out, not just to the frontliners, the mid caps, but across sectors as well. I guess, that basket buying, I think Nimesh was mentioning that on Friday in our Closing Bell show about the basket buying from FIs across segments, and that's something that's perhaps playing out now.
Well, it is buying basket or otherwise, and it is showing, isn't it? I mean, price is looking super, super strong. Price action. Gautam Trivedi is now joining us. He's co-founder and managing partner at Napian Capital. Gautam, good to have you with us here. I reckon it's possible that you join us when we'll have to announce and the Nifty hits a new high. So just 10 points or 15 points away. How are you feeling, Gautam, about the market and your thoughts? I mean, very strong rally, especially in mid caps and small caps.
Yeah, I think you're absolutely right. This is not just an India phenomenon. It's actually a global phenomenon. If you look at the Nikkei, the DAX, both at lifetime highs, the CAC in France is also near a lifetime high. So I think you're seeing this as a global event. It's not happening and limited only to India. From an FI or FPI perspective, should I say, we're the fourth largest recipient of foreign flows year to date. So if you look at China, northbound flows, they've been $28 billion. Korea has been over $13 billion. Taiwan's $9 billion. And we're now about just under $6 billion, I believe, in year-to-date FI flows. So I think, having said that, I think the market still has legs to go. And the reason I say that is the fact that when the market hit a premium, and I'm talking about MSCI India over MSCI Asia ex Japan, hit a premium of 96% is when actually the market actually took a huge tumble late last year. And that premium contracted to as low as 48% by mid-March, early April. So that's when the foreigners actually came back. And I believe that the premium now is roughly about 57, 58%. So I think there certainly is more foreign money that India can certainly absorb across large, mid, and small caps.
Gautam, hi, good morning. By the way, I just wanted to make one mention on the market. Although we are, almost approaching all-time highs, the Bank Nifty today is not really performing as much. It's absolutely flat at the moment. And there are some banks like IndusInd Bank, ICICI Bank, SBI that are actually dragging the markets and preventing the Nifty from getting to an all-time high. So just wanted to mention that point as well. Nothing alarming, but just one data point. Gautam, where do you see market leadership now? Because, this very interesting market sectors that haven't performed for years are coming back in a big way, whether it's autos, real estate, defense. Of course, defense now, it's been 1.5 years of a rally. But where do you see the next leaders come from?
The question really is this rally too narrow for comfort? And frankly, if you look at the Nifty 50, 10 stocks, the top 10 stocks have basically accounted for more than 50% of the gain since mid-March when we hit the low of the year. Similarly, if you look at the S&P 500, literally 8 tech stocks that account now for 30% of the market cap of the S&P 500. And again, there it's been a pretty narrow rally. Question really is this going to now expand to a broader rally? And I hope it does, because as you said, you named a few sectors that we've seen rally, which hadn't really participated until recently. I think there is scope even now for maybe real estate still on, cement, some degree of cap goods still to go, because the bulk of the capex of the government in the budget, which itself is a record number, will start to kick in given the fact that we have a big election next year. And of course, a whole bunch of state elections later this year. So I think these are the 3 sectors that I would focus on as hopefully continuing to participate in the ongoing rally.
Gautam, hi, good morning, Surabhi here.
Hi.
I'm a little surprised that you haven't found the rally broad enough, because whether we're looking at the month of June, I was looking at data. So in June, the micro-cap index is up 7.5%. This year, calendar year 23, that index, the micro-cap index is up some 17%. Nifty's up 4-5%. In June, the Nifty's up 2%. And actually, banks have been underperforming, right? You made the point earlier about foreign capital, and that's the narrative, that we should be getting more foreign capital. But then why are the big boys really underperforming, so to speak? And a lot of this money is chasing actually mid-caps, small caps, and even micro-caps. Do you see this continuing to be the defining trend over the next few months, or do you see that changing?
You know, Surabhi, that's a good point. But the fact is, typically foreign investors are not that kicked about small and micro caps. So a lot of that definitely is retail or HNI led in India. You don't see too much foreign participation below maybe a $1.5 to $2 billion in terms of market cap. So I think the FII money is clearly coming into the larger caps. If you look at March, April, and May, the numbers that I have with me, over $3 billion has come into financials, and that's partly been funded by about $1.5 billion of selling in IT, which I think is an area to look at as well, because some of these stocks have had a massive correction. I mean, Infosys, as an example, we do own the stock in our portfolio, but that stock's down more than 15%, and it's been the worst performer in the IT pack, at least among the large cap IT stocks. So I think the rally will get broader. I'm confident of that happening. It's just that I think foreigners typically don't participate in small and micro cap.
Yeah, no, got that point. Gautam, so, you know, at a general broad level, Gautam, what are you doing? Are you taking some profits off the table? Or are you investing more? Are you staying put? What are you doing?
No, we're definitely not taking money off the table at this point of time. I think we are still out there looking for stocks that could potentially participate in the rally or have been laggards and could join the rally. I just got back from the US where I spent over a month meeting a whole bunch of fund managers and asset allocators. And believe it or not, the interest in two countries, which was the highest, one was, of course, Japan, which is the Nikkei is now at a 33-year high, and the second being India, which probably today will hit a new lifetime high. But not even 9 out of 10, but 10 out of 10 investors said they've been burnt in China and are super excited about putting incrementally more money into India. So I think if that is indeed the mood, and of course, a lot of these allocators made visits to India in the first quarter of this calendar year. So I think hopefully a lot of that translates into money coming into GEM funds, India offshore funds, and that money invariably will end up finding its way into the Indian market. So if that happens, I think this rally will continue. And at this point of time, we're certainly not in a mood to book any major profits.
Okay. The space to be in lately has been metals, right? I mean, I just pull up the chart of JSPL. We were telling you about that earlier as to how Kotak has upgraded JSPL. And Gautam, the Kotak report makes this point that in the next 12 months, there are several projects that are coming up for commissioning for JSPL, and their capacity is expected to increase by about 65 to 70% over the next 2 phases. Is this a time to be betting on the metal names? If yes, is it the ferrous space you like, non-ferrous? Which are the pockets that look good from a long-term horizon?
Yeah, we really don't invest in cyclicals, but my personal view on metals is that a lot of that China reopening ended up being a bit of a, hasn't really played out as well as people expected it to. And I'm not sure if the rally in metal stocks is really going to necessarily sustain. So that's my personal view on metals.
Okay, got that. Gautam, great chatting with you as always. Thank you for joining in. Didn't get the all-time high, but so what? I mean, I think it's a market where the mood is pretty optimistic, and I guess that is really important from investors' perspective. By the way, the reason we're not getting to that all-time high, it is banks, like Sonia pointed out, but today you don't have Reliance helping. You don't have something like a HUL helping. So you've got a little bit of a profit taking that's quite evident on the other side of the screen. The life insurers, remember the huge rally that we had on Friday? Life insurers are cooling off a little bit. The red side has a fair amount on the other end, countering for the greens, and therefore you're pretty much stuck in that range. Volatility 10, 15, 20 points here and there, but yes, that momentum that the bulls would have hoped for, that big push through to the all-time highs, that's missing right now. Maybe it picks up in the next half hour. Who knows? It's a long day ahead. But let's keep the conversations flowing. Nilesh Shah, Managing Director at Kotak Mahindra Asset Management Company, is with us. Nilesh, good morning. Great to have you on the show as always. So I want to start not with when will the all-time high come or not, but I want to ask you, when you speak to all of your fund managers, do they still find a lot of comfort in this market? Are they still enthused with a lot of ideas, stocks available at least reasonable prices, if not cheap prices? Or is stock selection getting difficult after what has been a breathtaking rally so far this financial year?
So one, to some extent, my fund manager's job has become easier as investors have started behaving very, very maturedly. When markets are cheap, let's say 17,500 and below, we get SIP plus subscription. When markets are expensive, let's say 18,000 and above, we get SIP minus redemption. And last month, flows did come down, keeping in mind that behavior. But notwithstanding what happens on the liability side, we have to focus on asset side. And over there, yes, it is a bit difficult to find value in this market. It's a fairly priced market, neutral market, and one will have to be careful in picking up stocks at this point of time. By and large, we are long-term investor. Our portfolio turnover is about 10-15% a year. So we are not really looking to buy things with 1 year or 2 year view. We are looking to buy things with a longer term view.
Nilesh, hi, good morning. It's a great time to be chatting with you since the markets are at all-time highs. The mood in general is good. But, you know, we were having this discussion on our show Editors Roundtable, and almost every expert agreed to the fact that there is no euphoria in the market just yet, right? I mean, plenty of stocks are still well off their 52-week highs. Do you feel the same, that although the markets are at all-time highs, this euphoria from retail, this, you know, everybody jumping in because of the FOMO factor has not culminated just yet? And if yes, could that mean that there is perhaps more upside to the market despite all the triggers being priced in?
So, Sonia, this might be a little bit of bragging, but take this in a lighter way. The euphoria about India today is now with the FPIs. They were on exodus mood between October 21 to June 22, selling about $35 billion. And now they are buying back the same stocks at a higher prices. So undoubtedly there is euphoria about India, but that's more on the foreign portfolio investors than local investors. The local investors have been buying equity on a regular basis. By and large, they have been coming via mutual funds, right, rather than going directly into the market. By and large, they are focused on quality. So overall, retail investors have matured a lot. This is not to say that everything is hunky-dory in India. Even today, 89% of retail investors who are going to trading in FNO end up on the losing side. So there are two India coexisting, one matured, experienced investors participating in long-term story, the other which is trying to trade in the market, gaining the experience that trading is generally injurious to your financial health.
Nilesh, I think you and I have spoken about, I think over the last 15, 17 years, various points we've spoken about, you know, the fact that India's time has come, right? But this seems like one of those, and you're absolutely right. You look after publication after publication. In many ways, the stars seem to be kind of aligning. One factor, one new factor, which I think was not present in the earlier occasions, was the absolute, maybe a strong word, but you know, disgust investors are expressing towards the largest EM market, which is China, right? So that means that they're looking for opportunities elsewhere, and that is a really big one. It could be a big structural factor if that stays that way. We have Prashant Khemka also joining us, founder at White Oak Capital. Prashant, great to have you with us here. Thank you very much for your time. What are you guys doing at White Oak with where the market is now, and how are you thinking about it, more importantly, directionally from here?
No, certainly, very apt point that you noted about China. I think the leadership there for geopolitical priorities has what that has meant is the economic policies have taken a back seat. And that is playing to India's advantage when India is on the front foot in terms of its economic policies. So these confluence of events that have come together which includes the fact that COVID and Russia-Ukraine is now business as usual. We are end of the global rate cycle, and without a massive fall off in economic activity in the world's largest economy that was anticipated, and this largest EM market, as you pointed out, competitively falling behind India, I would say, in economic terms, has meant a big boost to economic activity, particularly in the manufacturing sector, and resulted in uplift in both the corporate earnings expectation as well as the multiple for Indian equities compared to the EM equity multiples around the world. So we are in our EM portfolio, for example, India is the largest position at this time, ahead of even China. And within India portfolios, obviously, we are fully invested as always, with largest exposure in sectors like financials and consumption.
Prashant, in your now and in your earlier avatar as a sort of global manager, EM manager, I was reading an article in the Financial Times, which talked about how investors are asking for ex-China EM structures. This is something we highlighted last year as well, but that now seems to be happening. I mean, just like this Asia ex-Japan came into being some 30 years ago, now it is ex-Japan, ex-China. I don't know if that, I mean, if you're hearing anything or is the media making too much of it? Just wanted your thoughts, Prashant.
No, very true. Now we have to be careful because these things come and go. But yes, over the last 12 to 15 months in particular, the demand for China, EM ex-China or even Asia ex-China has certainly surged. We've had several inquiries, several requests from institutional investors in Europe and elsewhere, whether we can consider having a tailor-made portfolio without China. I think this is the peak bipolarity, if you will, that I have seen in my 25 years investing career globally, where the negativity on China is at its highest and the positive sentiment towards India is at the same time very high. So this relative positive attitude towards India compared to China, I would say, is at its highest. And it manifests itself in several forms. One is this ex-China demand, but also the number of clients that we interact with globally who are for the first time looking at India as a separate standalone allocation. So many of the US investors historically have had EM allocation and a China standalone allocation. But today, many of those clients are looking at India as a standalone allocation and are at advanced stages of discussions, not just with ourselves, but in the industry with many managers, and several of them moving their allocation from China to India. So both these are at their peak at this time.
Absolutely, Prashant. I think, this is a sense we've been picking up from a whole range of market experts, Indian and foreign overseas. I think the consensus is that come, late summer or fall, perhaps we should see, a big pickup in FPI flow. So let's watch for that. But in the meantime, Prashant, let me draw your attention to the micros, really. And you're someone who's seen so many different market cycles, right? So this mid-cap rally that started, it's only about 2.5, 3 months old. But already, if you look at the calendar year, then the micro-cap index is up 16%, the mid-cap index up, 13, 14%. Nifty is only up 5% or 4.5%, less than that. Now, my question is that are you already noticing any pockets of, small excesses building up, which could be red flags, which investors should really watch out for? Or do you think this is actually a very, very nascent, longer-term bull market, mid-cap bull market, and we should be prepared to see euphoria, prepared to see very, very high multiples as well? How do we approach this side of the market?
Certainly. I think we always have to be watchful, but this time it doesn't seem like it is out of place compared to where the rest of the market is. Remember, prior 12 months, if you see, so as you rightly pointed out, this uplift in mid and small and micro caps is largely 2-3 months old. If you look at last year, 22, these segments had underperformed large caps. not by a huge lot, but that underperformed nonetheless. So there's been some time correction in this area. And even if you look at longer term, especially over last 5-year periods, it's not that these guys have, the smaller or mid caps have substantially outperformed the large caps. So I'm not saying these guys are undervalued particularly and should room to have a big rally because of valuation reasons. But yes, the momentum may build up further. I don't think it's reached euphoric levels at this time. There are obviously certain political events in India, particularly the central election next year. And if that goes in line with market expectations, then it is possible post that, if this momentum continues post that,
Sure.
that might result in some euphoria.
Okay, so there's no euphoria yet in the market. Got that. Now we are what, virtually about 40 points away from all-time high. So let me try and just wrap up with Nilesh Shah and his comments. Nilesh, what do retail investors do now? Investors who have perhaps not jumped onto this rally as early as they would have, thought to. What is the best way to approach the market now? Do you load on to some of the sectors that have done well up until now? Do you find new leaders in this market? What's the best approach?
Sonia, I'll simply say, do your SIP in mutual fund and participate in India growth story. It's never too late to start your journey in SIP in mutual funds.
Okay.
Okay.
Go ahead. Go ahead.
Nilesh, give us some
It's
more insights,
never too late.
some ideas maybe. I know we can never discuss stocks with you, but as a house, Kotak has been extremely optimistic on the manufacturing space. I think you guys like cement a lot, for instance. But maybe some more specifics where you still think valuations are reasonable and one can build that, multi-year portfolio.
So clearly, this is a market which is fairly priced. There will be volatility in the days to come, thanks to various events from Fed pivot to central election. My recommendation to investor is, just build a diversified portfolio. If you are beginning, then a large cap portfolio is better. If you are a veteran, then dabble in small and mid cap also. But maintain a disciplined asset allocation and regular investing. Every correction is a great opportunity to enter Indian growth story.
Okay, got that. Prashant Khemka, final question to you. Markets at all-time highs. What do retail investors do? And what's the best strategy to adopt for the next 12 to 18 months?
As always, I would say stay fully invested. Figure out for yourself what's a comfortable level. That may be different for every individual, but don't try and time the market come in and out, because those are, in the final reckoning, the people who are left behind, who try and come in and out. I think, as Nilesh Bhai at some point in time has mentioned, the returns that investors get is a function of time in the market rather than timing the market. And that's very, very aptly put. And if you think you are expert investor yourself in stock picking, indulge in that and enjoy that. But otherwise, the right advice, as Nilesh Bhai gave, invest in a good mutual fund, ideally through SIP, so that you get time diversification as well. But regardless of how you invest, stay fully invested at all times would be what my suggestion would be.
Okay, stay fully invested. That's some sane advice coming through. When markets are at all-time highs, people start to get a bit jittery. But I guess the optimism from both of you is flowing through. And thanks a lot for joining in, Prashant Khemka, Nilesh Shah. Appreciate your thoughts here on CNBC TV18. Well, that's the word coming in on the market. Prashant Khemka saying India is their largest position in the emerging market portfolio. They're fully invested in India right now. And several investors are moving their allocations out of China and into India. Let's sip into a quick break. On the other side of the break, we will be joined by George Alexander Muthoot, who's the Managing Director at Muthoot Finance, to discuss the company's business outlook. Later, we'll also connect with Gangadi Madhukar Reddy, who's the MD and CEO at MedPlus Health Services, to discuss outlook on their business going forward. Welcome back. With the markets at all-time highs, there are plenty of sectors that are at all-time highs as well, and the sectors that are doing well. Muthoot Finance, actually the first corporate on our radar today. The company's Q4 performance, especially in the gold business, was very strong. The assets under management have risen by 9% year-on-year, while the loan growth saw a nearly 10% rise sequentially. George Alexander Muthoot, who's the managing director at Muthoot Finance, joins us now to talk more about that. George, thanks a lot for joining in. Always great speaking with you here on CNBC TV18. I wanted to understand, the last time, of course, you told us that your core focus will continue to be in the gold market. But over there as well, competition has intensified. There is a little bit of pressure that you have been facing in the recent past. So I just want to understand, how is the competitive landscape now in the gold loan segment? And what would this mean in terms of your, growth, the AUMs, etc.? Will it continue to be in double digits in FY24? And what's the outlook?
Good morning. Thank you. And the outlook for gold loan is quite good. We had said that we would be growing well this year. Last quarter has been good, and this quarter is also equally good. We are happy that the sector is growing. Gold loan business for Muthoot is also growing. Last time we had been saying that for Muthoot Finance, the primary focus is always gold loan, and it will continue to be a focus going forward also. So we had last year, in the last conversations, we had suggested or we had indicated a growth of 15% in the gold loan AUM. I think we should hold by that, because as the trend in the last quarter and this quarter we see is that we may be able to, or we will be quite comfortably be able to do the 15% growth in the gold loan AUM this year.
Mr. Muthoot,
Next, you also want to know about the competitive landscape. Yes, quite a few players have actually started entering into this market. The few NBFCs have come into the market, and some of them have started giving gold loan also. But then, from the what previous experience or experience I have with others also, other NBFCs also joining the gold loan, I feel that after a while, fatigue will start coming in, and these NBFCs will move their focus from gold loan to something else. That's what I have seen earlier. As regards to the banks, especially the PSU banks, and all the banks which had quite a lot of, bad loans, sticky loans in the big corporate sector, have now turned their attention to gold loan. And in the last 3-4 quarters, most of them have been doing gold loans. Of course, they have a big branch network.
right.
The banks have about 60,000 plus branches all over India, and quite a few of them are giving gold loans also. But then, by the banks giving the gold loans, the market is deepening. More and more customers are getting into the gold loan bandwagon. That means they are getting more comfortable to do gold loans. Gold loan is actually a very smart way of taking a loan, and people are realizing that. The market is also increasing. So although competition is coming, we, as from our side, have not seen any dip in our growth. And as I said earlier, we will be able to do the 15% plus growth in the gold loan sector this year.
All right, Mr. Muthoot, that's a very comprehensive response. Actually, there was a bit of a dip earlier, but the dip was reversed. Fourth quarter was very good. And that 15% growth, I mean, we spoke with you about a month ago, and that 15% growth is reassuring to the market. Investors have taken note. Your stock started to repair some of the damage it has seen. Actually, NBFCs and banks entering the space is, in a way, yesterday's story, right? The new story is competitive intensity coming down, what you've been telling us in the last 2 or 3 interactions that we've had with you. Is that correct, sir?
Yes, I stand by it because the competitive intensity is coming down because the NBFCs and banks are also looking elsewhere for their growth, not the gold loan. It was good earlier, but now they are also realizing that it is not that easy also. It's a quite a few process-oriented and operationally challenging business also. So I think after a while, they will reduce their focus. But I'm sure even with they're continuing to do this, we should continue to grow our book.
Okay. So, Mr. Muthoot, I guess you've made it very clear you're expecting 15% growth in your gold loan business this year, and you're not too perturbed with this competitive intensity. So then let's talk about some of the other business internals. We seem to be in a long pause kind of a situation with respect to the central bank, though the RBI keeps saying this is just a pause, it's not a pivot. But what is your outlook on the cost of funding? In the fourth quarter, margins tapered off a little bit. I mean, you were down to just below, I think, 12%. What is the outlook?
I think the cost of funding, the cost of incremental borrowing, I think it is stabilizing. It is not going up any further. In the last 1 year, it has gone up by about 100 basis points. But the gold loan being such retail loans, we were able to maybe pass it on to our borrowers, because borrowers also, when they borrow from elsewhere, whether it is a gold loan or any other loan, they have started paying higher rates. So when they have started paying higher rates in other loans, they wouldn't mind paying a higher rate in gold loan. So we have been able to pass on that. Coming to our margins, our spread, we would like to keep it between 10 and 11. I think going forward also, we should be able to maintain the spread of 10 to 11% on our gold loan.
Okay, that's on the gold loan side. We've talked about that at length. Tell us a little bit about the non-gold loan portfolio as well. Mr. Muthoot, what kind of growth are you seeing there? And in terms of asset quality too, how is that shaping up for FY24?
Yeah, as far as the other loan books is concerned, we had gone into the affordable housing sector, and we also had a pause in the last 2 years because we were not growing that book well. But now that we have a new CEO also coming in the last 4 months, we are seeing growth in the last quarter. We are seeing good growth in the affordable sector, affordable home loan sector, and we should see good growth going forward also. We expect the affordable housing finance portfolio is about 1,200, 1,300 today. We should see it reaching 1,800, 1,900 by the end of the year. The other non-gold loan portfolios were the salaried personal loan, which we started. We have about 600 crores portfolio there. We should see it reaching to about 1,000 crores by the end of the year. The microfinance, which is done by our subsidiary, Bellstar, the microfinance sector has been doing well. Among the other peers in the market, the microfinance sector of Muthoot is also growing well. They have about 6,000 crores of portfolio, and surely by end of the year, they should also reach about 8,000 to 8,500 crores. So the other portfolios are also growing. We recently started a very fast personal loan to our gold loan customers also, very small portfolio. But then that is also being offered to our gold loan customers who have a good track record and who are willing to pay the EMIs. Today, the gold loan, what we give is all bullet loans. So those who are interested, they can take the EMI loan as a quick personal loan.
Got it, Mr. Muthoot. It's a pleasure as always, sir. Thank you very much for joining us and running us through all of that detail. Directionally, looking good. And that's what markets want to hear. Thank you very much for your time here on CNBC TV18. Well, let's talk about another interesting company. MedPlus Health Services is the company on our radar. The company is on an expansion spree in FY23. They added a total of 1,074 stores. With respect to online stores, companies say that they continue to expand coverage of PIN codes for orders online. The stock's done well. I mean, late last year, stock was at about 600. It's come up to 800 now. Gangadi Madhukar Reddy is Managing Director and CEO at MedPlus Health Services, and he's joining us right now to discuss how business is doing. Mr. Reddy, good to have you with us here. Good morning. Thanks very much. Prashant this side. I want to just start with, we have your sort of FY24 guidance numbers, revenue guidance numbers. I think you were guiding for flat margins, 20-25% growth on top line and flat margins for the full year in FY24. But with just 15 days for the first quarter left, could you tell us how is discounting looking like? I mean, is the pace of discounting coming off? I'm talking about online. What's the picture, if you can tell us?
Yeah, one would expect that with the problems being faced by a bunch of the online guys, that the discounts would actually come down. But unfortunately, it is not really true. We have at least one major competitor who is continuing to advertise and continue to advertise the big discounts and all. So while one of them, Pharmacy, has come off a little bit, I don't think the intensity has really come down that much. So that's all I can say. I think all the journalists have been talking about the funding issues of most of these companies and the fact that all of them have been talking about reducing the discounts, but in reality that has not really happened, Prashant.
So what does it mean for MedPlus, sir? I mean, in that scenario, I mean, one is backed off. You're saying one competitor still persists. So where are you at in terms of discounting and sort of being competitive, really?
No, for us, we have always been the price leaders out there. Most of the online people have actually given discounts of 25% or so on the first 3 purchases or on some special occasions. And then they try to actually drop the discount to 15 or 16, which is a viable number for most of them. So for us, though, we have always maintained the 20% discount on all bills above 1,000 and 10% below 1,000. And that's continued. So as far as a customer is concerned, if we were to strictly look at it, after the first 3 purchases in any online platform, we would be the most competitive ones. But most people, what they end up doing is after they do the first 3 or first 2 purchases on their own phone, they end up, going to their spouses or children or someone else's phone. And so they exhaust that full thing in their family before they actually start thinking about someone else. And unfortunately, in the past, what has happened is by the time a person exhausts this, some other competitor comes in and says, okay, I also want to give the 25% discount. Sure. So that thing has been kind of perennial, honestly.
So, Mr. Reddy, I think the reason why Prashant has asked you about this discounting and how the intensity has gone up, etc., is because if you look at your own business as well, right? I mean, your margins for the last 8 to 10 quarters have been in that exact same range of about 6 to at best 7%. It hasn't gone beyond that. And now with this discounting going up, with this intensity, competitive intensity rising, the fear is that perhaps margins could continue to either be in that range or maybe even fall further. Is that a legitimate concern? And if not, what would the margin band look like, say, in the next 1 to 2 years?
Okay. So our thing is a function of the rapid growth which we have. We have been adding at the rate of 1,000 stores. We added 1,074 stores last year on a base of roughly around 2,700 stores. So roughly around 35% odd stores, right? So given that all these stores will take a little while to actually mature, that's been a drag on us. And given that we had actually added 750 even the year before, and that was also a 30-35% growth on the base, you actually did not see any improvement in the margins out there over the last 2 years. But and again, as an extension of that, the fact that 50% of our stores are under 2 years, and post 2 years is when we actually make the actual EBITDA. We are going to be seeing this for a while. This year also, we are looking to actually add anywhere between 800 to 1,000 stores. And so you can expect it to be a flattish kind of thing as far as the normal business goes. But, as we continue to add sales on top of the 4,500 crores, I do not expect that our other costs, which would be, let's say, we would start getting some benefits of scale. My warehousing costs will not go up in the same level, and neither will my corporate costs. So we will see some benefit out there as we go forward, but the drag because of my new stores is going to be there. While online and the other discounting has affected us a little bit, it's not done so majorly because, end of the day, the complete online thing is actually less than 2 or 3% of the overall country at this point of time. So honestly, while it does take off a little bit of shine off our SSG, it is not a major factor.
Okay, Mr. Reddy, just I've been hearing you make a lot of very interesting points. Just to wrap it up first before I move on to the question, you're saying expect flattish trends on margins this year because of the this huge impetus of new store opening. So we should expect margins to average out around the 6% mark for FY24?
Maybe slightly better, you could say, mainly because we will definitely see some scale benefits.
Okay.
But yeah, that would be the general trend.
Maybe just slightly northwards of 6%. Okay. So